Good morning and welcome to the Killk & Co Market Update. The FOMC's messaging on Wednesday was clear and decisive, vowing to use all of its tools to support a recovery from a downturn worse than the GFC. The Fed made no major changes to monetary policy and reiterated the considerable risks to the medium-term outlook whilst maintaining its forward guidance for rates and asset purchases. They did add a line to the statement that the path of the economy will depend significantly on the course of the virus, which of course makes a huge amount of sense. Jerome Powell was a bit more direct in his press conference, saying that the surge in virus cases has slowed the pace of the economic recovery and cautioned that we do not know yet how long the slowing is going to last. And his comments were enough to push bond yields and the US dollar lower once again. He also highlighted weaker credit and debit card spending and a rise in some measures of unemployment since the end of June as concerns. He again flagged the need for more fiscal support as Republicans and Democrats continue to wrangle over new fiscal packages. And as we know, the existing enhanced unemployment benefits expire this month in the US. So there are no further details on how the Fed might provide more specific forward guidance at upcoming meetings nor on the likely outcome of its policy framework review, only that the review will be concluded in the near term. So when we see the July meeting minutes in a few weeks' time, they may begin to provide some nascent steer as to the course the Fed may take. The reason that people will be looking to the forward guidance is that it provides a runway of sorts as to under what conditions the central bank may be more comfortable in taking a bit of a step back from supporting markets. And of course, that's something that will have an impact on most asset classes. It was a big week for tech this week. We saw CEOs grilled by Congress over concerns surrounding antitrust. And last night we had earnings from Apple, Amazon, Alphabet and Facebook. So these four companies make up over 30% of the NASDAQ 100 on a market cap basis. So earnings here are always a fairly big deal. We can see here that the options market was implying a reasonable bout of volatility around the earnings. And that's not too surprising given the average price move of each company the day after they report. Now, important to note here that the implied move doesn't tell us which direction the market thinks the stock's going to move, just that it's pricing or expecting a move in either direction of X%. The market, as we know, is not always correct, but these tend to serve as a useful barometer to gauge expected volatility in share prices over an earnings announcement. You can see here, this time round, the market wasn't too far off the mark. In the after-hours market post-results, we saw Facebook up 6.5%, Alphabet up small, up 0.5%, Amazon up 5%, and Apple up 6.5%. So if you take a look at each of the companies in turn, Amazon reported a surge in sales and record profit of $5.2 billion, which came in well above analyst expectation. The pandemic's clearly increased demand for Amazon's retail business, well above normal levels for the second quarter, which is usually the lowest volume period of the year for them. Amazon Web Services, which the cloud computing division, had revenues of $10.8 billion, which is up around 29% from a year ago. Looking at Facebook posted a strong beat on revenue, which surged 11% to $18.7 billion. Its results were driven by a rebound in ad spend in May and June and shelter-in-place orders around the world driving the use of its messaging services. The company is facing a boycott of its platform from advertisers in the current quarter, but it did say that revenue was up around 10% in the first 3 weeks of July. Alphabet reported their first ever drop in annual revenue as advertisers pulled back on ad spend in the quarter. In spite of this, they still managed to beat analyst forecasts. Bright spots included revenue growth from YouTube and also the cloud business. And finally, Apple, whose revenue also grew 11% to $59.7 billion. CEO Tim Cook said that the pandemic has likely boosted iPad and Mac sales because of more remote working and learning. However, the pandemic was also weighing on sales of iPhones and wearable devices, with online sales not fully making up for offline sales. The company also announced a 4-for-1 stock split in a bid to make the shares more affordable. So the term stock split is an industry jargon, I guess, that really means that a company is dividing its existing shares into multiple shares. This has the effect of lowering the share price, but not the value of the company. So in the case of Apple, if you're an existing shareholder, you'll be given an additional 3 shares for each share you currently own. And the value of the 4 shares that you now own will equal the value of the 1 share you had previously. So all in all, a strong showing from the tech majors, which saw shares of all 4 companies trade decently higher after their results. Now, as always, there's been plenty of things for us to keep tabs on, so I thought I'd just highlight a few things or a few of this week's top stories. So this week we've seen UK travel company shares trade lower, with TUI and IAG, for example, down around 10% on the week. This is following news of the UK government advice against travelling to mainland Spain and its islands based on its current assessment of COVID-19 risks in the country. We saw new all-time highs in gold, up to $1,981.27 an ounce, which surpasses its 2011 record. We had news that US GDP fell at an annualized rate of 32.9% in the second quarter, which is actually better than expected, but is unfortunately still the worst print since the 1940s. The ECB suggested that European banks should not pay dividends until the economic effects of COVID see an upturn. We had sterling dollar exceed 1.3 or 130 for the first time since the pandemic really started gaining momentum in March. The US 5-year Treasury yield hit all-time lows following the FOMC's Wednesday meeting. And Eastman Kodak, the US camera maker, came back from the ashes after it received a $765 million loan from the US government to make pharmaceutical products in the wake of the pandemic. And the stock rose from $2.13 on Monday to $60 on Wednesday, and that's a move of over 2,600% in 3 days. Amongst other things, Donald Trump floated the idea of delaying a US election in November, which took some of the limelight away from that GDP print. Looking ahead to next week, we're now halfway through earnings season in the US and Europe. We'll of course be keeping our eyes open, but these are some of the companies we'll be keeping closer tabs on. That's it from us. Stay safe, and we'll see you next week.